Have you ever seen a company report its best quarter ever, only to watch the stock completely tank? Well, that's the bizarre story of HF Foods Group. On paper, their second quarter was a massive win, but the market was, let's just say, totally unimpressed. So today, we're going to dig in. We'll break down the numbers, what management is up to, and exactly why Wall Street isn't buying the good news. All right, so let's dive right into the headline numbers from their August 11th report. And really, on the surface, you'd think this was an absolute home run. I mean, records were broken, expectations were completely smashed. First up, the top line. We're talking a record $314.9 million in net revenue. Now, that's up over 4% from last year. And you got to remember, this is happening in a really tough environment, right? You've got inflation, you've got supply chain headaches plaguing the whole industry. So to see that kind of growth, that's pretty solid. And then you look at their profitability, and wow, adjusted EBITDA shot up over 31% year over year. And what that tells you is they're not just selling more stuff, they're getting way more efficient at doing it. This wasn't some kind of fluke. It's clear they've been working hard to streamline their operations and really get costs under control. So how did this stack up against what the experts were expecting? Well, it was a clean sweep. They beat on revenue, they beat on earnings, you name it, they beat it. Look, by any textbook measure, this was just a fantastic quarter, no two ways about it. So what's the secret sauce here? How'd they pull this off? Well, according to management, it all comes down to one massive, company-wide project that's been the engine behind all this success. Yup, CEO Felix Lin basically put it all on their brand new ERP system that stands for Enterprise Resource Planning. You can think of it as a new super smart central brain for the entire company. It just went live back in May, and it's really the core of their whole operational turnaround story. And the idea behind this thing is pretty powerful. First, you get everyone on the same page, right? Unify the entire operation onto one platform. Then you can centralize all your buying. Instead of a dozen small orders, you make one giant one, and that gives you way more power to negotiate better prices. And finally, over time, this should help them trim the fat on sales and administrative costs. It's all about becoming a leaner, meaner, more profitable machine. Okay, so the internal story is looking great. They're executing, they're getting more efficient, but, and this is a big but, all of this great work is running smack into some pretty serious external headwinds. And this, right here, is where the story starts to get really complicated. And this right here just lays out the disconnect perfectly. On one side, you have management, and all they want to talk about is their awesome new ERP system and their plans for acquisitions. But on the other side, you've got the market, and all it cares about are things like tariffs, whether consumers are going to stop spending, and this big fear of share dilution. It's a classic case of a company telling one story and the market hearing something completely different. Which brings us to the moment of truth, right? The market's reaction. Because you've got the earnings report tape, which looks amazing, and then you've got the stock market tape, which, well, it tells a very, very different story. So let's just walk through what happened. On August 11th, the report comes out, and boom, the stock pops after hours, up about 3.4%. You'd think, great, here we go. But then management mentions they're seeing softer foot traffic in restaurants. That's concern number one. And then on September 25th, they drop the big one, a $100 million at-the-market equity program. Now, all that means is they can sell new shares whenever they want to raise cash. For investors, that screams one thing, dilution. My piece of the pie is about to get smaller. And just like that, the initial pop was gone, and the stock started trending down. Okay, so let's put it all together. We've got a company that operationally is firing on all cylinders, but it's also battling these major market headwinds and the self-inflicted wound of potential dilution. So, where do we land on the stock? It's time for us to make the call. But before we do that, we need some context. Just look at the one-year performance. The stock is down over 21%, while the broader market, the S&P 500, is up 17%. That is a massive gap. It tells you that this skepticism from investors isn't new. It's been baked in for a while, and one good quarter just wasn't enough to change their minds. And really, it all boils down to this one single question. Is all the great work they're doing on the inside, the ERP system, the efficiency gains, is it enough, is it powerful enough to fight off the macro risks and this cloud of dilution hanging over the stock? That's the whole game right there. So after weighing everything, our rating is market perform. And what that means is we see the company making real, genuine progress. That's fantastic. But we also think the stock price already reflects that. It's priced in the good, but it's also priced in the bad.
So here's the breakdown. On the plus side, that ERP system is a legitimate game changer for their margins. And look, they are a dominant player in their niche market of Asian food distribution. But the cons are just too big to ignore right now. The slowing economy, consumer spending, those are real. And that $100 million equity program, that's a huge weight on the stock. Think about it. Every time the stock gets a little momentum and starts to climb, the company has an incentive to sell more shares. That puts a lid on any potential rally. And that, in a nutshell, is why we're staying on the sidelines with a market perform rating.
And as always, just a quick and very important reminder, this analysis is purely for informational purposes. It is not and should never be considered financial advice.